All right, well, hello to all of our viewers. My name's Jeff Gibbons with Rich House Advisors. I'd like to thank my good friend Chris Brannan from PPC for joining us today. Chris serves as the firm's Chief Compliance Officer, as well as the Director of ESG. And Chris is going to help us explore the concept of what we call resilient sustainability in the private markets. In today's discussion, we're going to cover sentiments and trends on ESG and broader sustainability from institutional investors, so limited partners, general partners such as PPC, portfolio companies, and finally, the strategic customers that Chris's companies do business with. Chris, maybe you can start with a quick overview of your firm.
Thanks, Jeff. Thanks for having me and giving me the opportunity to discuss PPC and our journey over the last 7-8 years in this space. So PPC's, we're an investment firm based in Chicago, about 60 employees, little north of 10 billion AUM. We have 17 control investments specializing in manufactured products and industrial and commercial services. We first crossed paths with you guys back in around 2018 when we were spinning out from the family office of Tony Pritzker and his family. And back at the time, being the first time we raised outside capital, the expectation at the time was have an ESG policy. So policy is a legal word, came into my department, and we've been running with it ever since. And at the time, it was high level, you're going to integrate ESG concepts into your due diligence process and basic high level monitoring during the stewardship period. And being a new work stream, that's when we put out for request for service. You guys and a few firms came along, and we've been glad to be working with you guys for the better part of a decade now.
Yeah, same. We appreciate your business as well. So would you say, Chris, to borrow a phrase, that the born-on date of your program was around 2018 as a firm?
Yes and no. It was 2018 was really the first time the term ESG would, say, entered our vernacular. But there were some fundamental principles already in place during the family office, Pritzker family legacy era. I was going back and drafting our annual report from 2-3 years ago, and we were pulling together a firm history timeline with a lens of ESG on it. And I went back and found our company guidelines. This is a governing document we still have. It talks about everything from the high-level principles that we carry as a firm and expect of our companies, all the way down to this is the board cadence and agenda. And what I found, even in 2012, before ESG was really widely known, was a page fully devoted to expectations that companies operate with an eye on energy efficiency, environmental compliance, waste management and recycling, employee and product safety. It almost read like a SASB materiality matrix before we even knew the term ESG existed. So all that to say, like, there was already a really good foundation and principle for us to build this program on top of. So yes, the first time we drafted the policy was 2018, but plenty predated that.
So plenty of legacy before that. That's good to hear. And obviously it's a journey. And so one of our other investor clients has coined the phrase recently, the trough of disillusionment when it comes to ESG, which means, the early innovations maybe, and a lot of that came from just expectations from LPs around being responsible with their money. So responsible investment. And then you had the scrum a couple years ago, the competition for ESG talent, lots of promise associated with it and expectations. And then you have kind of where we are now, meaning that there's some uncertainty around the value associated with it. We have anti-ESG sentiment in some parts of the market. What I'd like to explore with you now is how are you, and let's go top down, how are you finding that with your customers, who you do business with, your LPs? Are they moving off of this? Have they changed their tone at all? What are you seeing from your interactions with your customers?
Yeah, I haven't noticed much of a dip in my view of the private markets. I mean, as a data point, right now we're getting a lot of our 2025 year-end DDQs from a lot of investors. We just wrapped up our PPC4 fundraise in the middle of last year, and there was a lot of front-end ESG diligence. If anything, it seemed through the fundraise process as even more integrated than before. A lot of institutional investors and large family investors will do on-site or virtual operations due diligence. And I was used to doing a good amount of that with my legal and compliance hat. I felt like I was doing more of that now, answering ESG questions, almost just as a fundamental part of their underwriting process.
Okay, great. Thanks, Chris. Have they, so from your perspective, they really haven't moved off of that, and what you're seeing from your investors is pretty consistent with what you've seen all along?
Yeah, I think a lot of the disillusionment stuff, if you're watching the news, a lot of that was public markets based. I think there were a lot of pension funds that were maybe investing in some high-priced, maybe ESG-focused type funds that maybe weren't achieving alpha. I think there were some state and local politicians on both sides of the aisle that were trying to apply a national voice from their state and local seat through the power and the money of their pension funds or their treasury apparatus. But I think RLPs, they're really, I like to, somewhat tangentially, I was talking to an investment professional at a mega sponsor a couple years ago, kind of asking, what do you diligence in our companies? I mean, a lot of our companies someday will be acquired by those types of sponsors. And I was trying to dig in on what are you really looking for in your ESG diligence. And they said something, we're not going to not acquire you as a result of having high emissions or a higher incident rate of certain types of factors. It was more, they view it as a leading indicator for a forward-looking strategic data-focused management team. And I think that applies to what LPs are looking for in a GP. So a lot of these large families and institutional investors, they might have investments in 50 to 100 plus GPs. Those GPs are invested in anywhere from 10 to 50 plus portfolio companies. There's a lot of coverage that their money is going throughout the world. And I think them diligencing our ESG practices, if you're a 10 billion AUM mid-market sponsor and you can't provide basic EDCI metrics, I think that could be a leading indicator that you aren't that focused on the stewardship process of your firm, of your portfolio companies, and you might be one of those firms that just will acquire you and then we'll see you at the next board meeting. And that's a heightened risk for a lot of these LPs. And they have their own programs to run too. So they want to know, are you going to be able to provide us the data that we need to run our own programs?
Good. That's consistent with what we're seeing across the market with our other clients as well. So appreciate your perspective on that, Chris. What about, let's maybe pivot to your companies. How are you approaching your companies today on ESG and sustainability matters, and speak to maybe their receptivity to that, or is PPC changing its approach in terms of engaging with your companies on these matters?
Yeah, I'd call it it's both standardized and tailored. There's a standard table stakes that, I mean, our core customers are our investor partners. A lot of them do have their own sustainability programs that they need to run, which requires data that works down through our portfolio. And that's table stakes. All of our control investments this year are going to report on the EDCI metrics and the SFDR PAIs. The next level will be, once we have that data, and it's often industry tailored, are there areas and things we could pull from that data for cheap and easy dollar wins? We call that turning data into dollars. And that's largely with some of the larger manufacturing companies. You have all their utility bills in one place. There's often things you can do with that data to actually drive some pretty substantial savings. And the third, and this is most tailored, and this has most to do with which companies are experiencing the most pressure from their, mostly their customer bases, and helping them actually develop their own independent, scalable sustainability program. So that sort of runs the gamut across. We're not a one-size-fits-all. We really try and not run a fully top-down approach outside of we need this data for our core customers and our core investor partners, so you're going to provide that. But outside of that, we do not require anything else from our companies.
Chris, what do you think's caused the recent rise in the customer pressure that your companies are facing from their customers? What do you think the genesis of that is?
Yeah, for the ones that are, I mean, some of our companies have no customer pressures whatsoever. They're selling to end consumers that are not integrating sustainability concepts into their product decisions or their buying decisions. But then there's others that, yeah, you have Amazon or Walmart, McDonald's, choose your company as a core customer, and they're seeing a lot of pressure. And I think that's really stemming from, you look at the 2018-19 to 2021 timeframe, and you had a lot of these companies going out and saying, we're going to be net zero by 2040. We're going to use half renewables by 2030. Various pledges like that. And then I think what you saw was for the next 2-3 years, they were going out throughout their supply chain and collecting data, kind of getting their arms around, okay, if we're going to actually hit this pledge, what are we going to have to do? Because it's important to remember, and I remind our companies, when Walmart makes a pledge, it doesn't have to just do with the brick and mortar stores and switching out LEDs in their sites and their trucks driving around. It reaches up and down through their supply chains, and that's where our companies fall into. So now you're just seeing required data and in some instances required actions for their suppliers, i.e. our companies, to operate in a way that's in line with meeting their pledges.
Interesting. And again, consistent with what we're seeing with our other investor clients and the portfolio companies we work with. So I appreciate that perspective. And again, with our relationship together, we've worked with you for a while. We worked with a number of your companies. If you could summarize for our viewers, what's worked and what hasn't in terms of not integration, but engagement with your companies and getting them to take action on these areas, and what's worked and what hasn't?
Yeah. I think the first thing that's been really successful is trying to stay a year or two ahead of like where the puck is going. And we're just our firm ethos, we are very engaged across our family of companies, and keeping a pulse on what are those leading customers, like where's Walmart at, where's Amazon at, and trying to stay engaged with the companies that are experiencing those pressures, because the rest of our family of companies might be seeing that a year or two later. We also see that through some of our leading investor partners. Some of them are maybe a year or two ahead of the rest, and seeing what they're saying, going to conferences, engaging with them to see where are things going to be in a couple years, and at that point, making these things optional across the group, not mandating things immediately. And there'll often be a couple of companies that will complete the optional reporting or complete the optional actions. So when the time comes a couple of years later for these things to become more table stakes and mandatory, there have been companies that have already solved the pain points and have gone through this. And then it's just a matter of connecting them and letting them share their experiences. So that's worked really well. Secondly was finding common ground. So I think a lot of people, like we do company onboarding in our 100-day plans to introduce them to the concepts of ESG and how we go about it. A lot of them view it, especially with the political climate, in very different ways. A lot of them just think it's a political marketing tactic. A lot of them just see the E side. So it's establishing common ground of, no, we're actually talking about a lot of people and talent practices, employee safety, environmental compliance, leadership development, cybersecurity, and that makes them realize pretty quickly, oh, we're already doing a lot of that. On the leadership development side, one thing we're really proud of is a program called PPC University. It's going on its 5th year. We partnered with the Indiana University Kelley School of Business, and we've had over 1,000 participants, well over 1,000 participants now, across the family of company to take virtual classes that are applicable to their day jobs, developing the future leaders. And a lot of people don't view that necessarily as part of an ESG program, but we really integrate that and show like this is a large part of our program is about investing in people and not just the E side of things that seems to get most of the attention. What hasn't worked, I'd say getting too stuck in acronyms and not really focusing on company priorities. I learned that pretty early. Like you hear frameworks and pledges, and without really focusing and getting buy-in on what's valuable to the company, nothing's going to change. If at the end of the day, if what we're actually looking at is scaled efforts that drive impactful outcomes, that all happens at the company level. That does not happen at the LP level. That does not happen at the GP level. So really learning that lesson of this is really not a top-down program. This is getting buy-in and showing value to the ones that actually matter, which are the company operators.
It's good stuff, Chris. Let's jump back up to the firm level, the PPC level. And I think some of our viewers want a little bit of hows, and I know that we've done a lot of, I would say, collaborative work together. Maybe you can describe how you built out the approach with our support as one of your partners at the PPC level. That'd be great to share. Appreciate it.
Yeah, you guys, you've built out your toolkit in line with our expansion, which has made things a lot better. I mean, initially it was predominantly deal diligence, and then based on that diligence, working with the companies at the beginning of the hold period to select basic KPIs applicable to their industry to report to their boards. Then over time, as we were mentioning, the optional to mandatory, the best example of that, scope 1 and 2 reporting, made that optional around 2021, 2022. You guys have some great professionals in helping companies mine the data out of their businesses and then translate that into emissions. Then earlier we discussed the company program development. You guys have been phenomenal in working with companies to do materiality assessments, so trying to gauge what are the priorities of their core stakeholders, usually the customer base, employee base, owners and lenders, and helping the companies distill that down into areas of focus. And then eventually, we're really proud that 10 of our businesses have churned out public sustainability reports, being transparent with their efforts. Again, entirely optional for the company to do that, but your team has been very instrumental in helping a good chunk of our companies put those out.
Right. I appreciate that feedback, Chris. I'll pass it on to the team. So this is not just a fleeting thing that your companies do under PPC sponsorship. How are you making ESG really stick or make it resilient with your companies as you kind of coach them through this journey, but then ultimately off to, your exit and their next sponsor, or maybe becoming publicly traded? How are you making it stick?
Yeah, the first part was just the very few things that are table stakes and mandatory. Just say that and help them complete that through advisory relationships, technology solutions. Oftentimes, those grounds were already tread by other businesses. So just connecting the companies and letting them learn from each other. I talked earlier about finding common ground, predominantly around people. Like, no one's going to argue that employee safety is not core, that employee engagement and talent development aren't core. Now, cybersecurity, those are, so educating them that this is actually part of the ESG program. ESG is just a layer of reporting and risk assessment to be layered across core operations and human practices. The other part, and this one's a little stickier, is around climate. So that is not a commonly held priority across every business. If you say the word climate, there's a lot of pressures on a lot of these companies now with tariffs, with interest rates being high. A lot of the senior teams have responsibilities to their investor bases, their employee bases, that the term climate doesn't really resonate with a lot of company executives. It does with some, but not all. But one thing that does, and luckily in our industry, a large chunk of the climate impact comes through energy consumption, is speaking the language that kills two birds with one stone. The core input for carbon emissions is energy consumption. Energy consumption impacts your budgets and hit bottom line. So speak that language and focus on energy consumption, and then you run the calculations and show emissions reduction off that. I think that's the way to really get that more, not controversial, but the area with different opinions more integrated into the core business, and showing that you are actually prioritizing the operational side of things, which has the externality of lowering climate impact, instead of just going straight top down with climate pledges.
So as a firm that's really been at this for a decade, what would you say are the key lessons learned to really making this work, regardless of what it's called?
Yeah, it's I try and not refer to it as an ESG program. Like whenever someone asks, like, you guys are good at ESG, it's like, what does that really mean? I view it more as a, like I mentioned before, an area of risk assessment, and then you have your core operations and people practices, and then you have your back-end transparency and reporting, because a lot of our company customers, our core investor partners, they really care about having that transparency that, okay, these people are part of my supply chain. They're investing my money. I want to make sure these are responsible stewards that are good investors that are also lowering my risk. So really getting it outside of the acronym, and more that the acronym is more of just a front end and back end tool to assess and report what's actually happening. But the actual happening and the actual difference making is just part of running a good business.
Yeah. Let's look forward now. Where do you see this going? What's next for maybe broader ESG sustainability in the ecosystem in which PPC works and functions? And then what about for PPC specifically?
I think one thing that everyone in my seat across the GP landscape is hoping for is an AI solution that can help reduce the amount of time spent on DDQs. That would be incredibly helpful. I'm pretty confident that will be in place by the time of our next fundraise. But having more time to be able to go at and connecting the companies, scaling best practices, finding those places to reduce energy consumption and carbon emissions, help with safety incident rates and other like impactful areas on the business, that'll be great. From a market perspective, I'm hopeful that the turmoil in the energy markets will lead to more investments in renewables. That can get cheaper to the point where I do think if you can ever get solar technology or renewable technology down to a standard 2 to 3 year payback period, I think all businesses will install that and operate off that as quickly as the production and installers can scale. So that's where I'm hopeful that goes. For our companies and our firm, where I think the puck is actually going for what's next, and this is what we're putting out there as optional now, and we'll have a few leaders that will blaze the trail by the time it becomes mandatory. I'm guessing that's in the space of formal Scope 3 emissions tracking and reduction and more formal decarbonization programs.
Okay, good stuff. So plenty to do and plenty to focus on moving forward. Do you have any parting thoughts to share with myself and our viewers?
Yeah, I think so. I started in this role not knowing anything about it, lawyer by trade, and just started going to conferences. I've spoken at a couple now, and the approach we've really taken, part of that is wearing a dual hat. I can't spend 40 hours a week on the program, but really realizing that like true change happens through human actions at the company level. We could sit at these conferences and I could sit in my seat working for the GP and mandate everything, but unless there's company buy-in and a company finds value in something to where their people actually act on it with urgency, you're not going to actually drive change. And at the end of the day, we're not here to pledge things 10 years out. What we really want is to build a better business and reduce the impact on the environment and the people in the process.
Excellent. Good stuff, sir. I think that wraps it up. Chris, thank you so much for your time and your perspective on this. Looking forward to continuing our relationship and looking forward to doing more good stuff moving forward and building better businesses.
Great. Thanks, Jeff.
Thanks for your time.